Welcome to the Pump and Dump channel for another weekly update, this time looking quickly at the S&P 500 and comparing the chart to the WTI price chart. And then of course looking at some of the narrative that's been coming out recently. So on the S&P 500 I noticed this downward wedge during the sell-off. I drew it on Monday. I looked at it and I was thinking it was looking really bad. Then we broke out to the upside on Tuesday. And I started asking myself how it would be justified. The only thing I could think about near term was the State of the Union speech by Trump, that could have a positive impact on sentiment. But then of course there was other stories coming out, like talks about the coronavirus having a cure now, or a vaccine, or made some breakthroughs, or whatever they wanted to call it. And ultimately, I think on the technical picture, what we have to look at is this support line here. It kind of held the support and then it broke this downward trend line to the upside. Technical traders probably would be buying here for the swing trade, and momentum traders will also join in once they see the breakout. But the question is, like, how does it go up? Why does it go up? And I think the only conclusion that one can come to is that the hedge funds who are borrowing money through the repo market, they not only hold the line, but they also bid it up. They have to like force the money into the system to take larger positions, because the pricing is always determined by those who hold the stock and have money to buy more stock at higher prices. And what people tend to do, including myself, and I'll get to that in a minute, is that when they see something like this that convinces them that the market is going to crash and is going to melt completely, they change their opinion once they see the price breaking out of that zone and they start seeing it rising, because that goes counter to what they thought was happening in the underlying economy, like the manufacturing data getting worse, the coronavirus spreading, and even the liquidity drying up from the last QE programs almost a decade ago. That you can see, of course, reflected in the low interest rates, because it's showing that cash flow is hard to come by. You can of course say that when bond prices are going up that you have earnings in terms of capital gains, but it's really signifying that the cash flow is drying up, and that is related to liquidity in the system, and that dries up over time whenever there's QE programs. So yeah, we had that breakout, and you can see, of course, in terms of where we made a new all-time high, but we kind of closed near the all-time high that was made a few weeks ago, which is below the current all-time high. So we kind of are in this channel here, and it really needs another substantial move up to get people to think that we are, back in a bull market. Now going to the WTI price chart, it's a similar story here. I remember talking about this in beginning of January. I saw this downward wedge here, this trend line had broken, and I thought that this signified that we're reaching a top based on fundamentals in terms of cost of production for oil in the US. I thought that we would be building a head and shoulders here and would eventually roll over. Let's make that a bit thicker. So I thought we were going to roll over. That was my assumption, and one could argue that on the S&P 500 chart we could be forming a head and shoulders and roll over. Now of course what happened was different. For WTI we had this breakout here, which was on the news that the US killed that Iranian general. Then the Iranians launched some missiles, and all the stories in the news turned to the possibility of war, and with war coming to the Middle East, the Strait of Hormuz would have been closed down very likely, and they would have had significant impact on the shipping of oil, and therefore one could say that the oil price would have just gone sky high. And when that news was happening, of course, I stopped thinking about the fundamentals and weighing that against the possibility of war, because when you have like a really strong catalyst that seems really overpowering, sometimes you make an assumption that all your analysis previously doesn't matter. And what we of course see is that in terms of the ultimate outcome, I was right, but I couldn't stick to it because I got caught up in the narrative of what happens if there is war, what will the oil price be in a war scenario. So you can see, of course, we rolled over. We're like at $50 a barrel. And this is kind of like the big risk now with the S&P 500. We could have a big move up, you know, and we could just roll over just like, you know, in WTI. There are of course like some bear flags here that are formed. Down here, this last one is a bit more difficult to conclude if that is really a bear flag. I'm going to get to that in a second. I'll just pull up my chart here. So as you can see on the chart here, of course I have my big triangle here where I see the oil price finding support if OPEC cuts production, or if they don't cut production, the price could go down on either of the two news items, whether it's bullish or bearish, it doesn't really matter. The positive at this point in time, I think this bear flag here is not really clear that it is one, but what is clear is that this downtrend here has been broken and we are now outside of this trend line, so that means we kind of could bounce off of it, stay above this $48, $49 mark, and that kind of could maybe get us back to $55, $60 a barrel on the price chart. The reason why I say that is possible is that if you assume that all the negatives from coronavirus is priced in, then why would the price keep going lower just if the coronavirus keeps spreading and the death toll keeps rising? So next point, I'll talk again about copper. I talked about it last weekend. I said I thought there was a possibility maybe for a rally. I think that's what I said at least. And I said that even if we do have a rally, it would not necessarily mean that the copper stocks would sustainably go up. It could just be like a trap to get people to think that this is a low for copper and they buy copper stocks, and then they get a position and then the price just keeps going and the stocks keeps going against them, even as the copper price, you know, stabilizes or starts rising. So as you can see here, we had 3 strong days, but now it's kind of back down. We were at 250 at the low and at 261 at the high, and we kind of closed near 254. And with Turquoise Hill, I talked about that. If you look at the chart, it was just like in December and January, it was, for the most part, it was between 79 and let's say 60 cents a share, so 60 to 80, and it kind of has held at 60 cents a share, and it went as high as 70. But it's kind of clear that when you have a 70 cents a share valuation, let's say at $275 to $285 on copper, when the copper price is down here at 255, it kind of doesn't make sense that the stock should still be trading at that level, especially with all the potential headwinds that comes out of this coronavirus situation, with the Chinese government clamping down on places and lots of manufacturing being shut down as a consequence of it. With Lundin Mining, I also talked about that one. I talked about how this trend line was broken when we're down here somewhere, and you can see, like, I think we might have been at 50 at that time last week. Makes sense, yeah. So we kind of rallied on the copper price rally, but we're back down here at 52 Swedish crowns a share from 50 at the low. And if we compare that to here, the 14th of January, at almost 59. So the 14th of January was here, this point in time of copper, 285. Now Lundin Mining is a bit different than Turquoise Hill, because Turquoise Hill is like 80% copper and 20% gold, and Lundin Mining is like 60 or so percent copper, and then zinc also has a major impact in terms of how it moves the valuation. So what we can say is with Turquoise Hill is that we can see that the price of the shares have rallied on the bounce, but the valuation and the price, they obviously have widened. The valuation has gone much lower, but the price has stayed up here. And there's really 2 things that can happen. Number one is the copper price comes back up to, let's say, 270. then maybe 66 cents a share could be justified. Or the alternative is that Turquoise Hill keeps falling and comes in line with the copper price. And the same would of course go for Lundin Mining. So yeah, I guess that's going to do it for this video. Remember, it's not investment advice or recommendations for you to buy or not to buy. It's just my opinion, how I see things. Just remember that the key point is relating to this wedge here based on bad news, and this wedge here that suggested fundamentally we should be going down. And if I am correct, we could have what they call a blowout top, and then we could just completely roll over on the S&P 500 and other indices. Now with that said, if you have any questions, comments or opinions, leave them in the comments section. If you like the content, don't forget to subscribe, and have a good day.